Welcome to QuickBooks University. I'm so glad that you're getting this video because I've worked with thousands of small business owners and others that want to learn QuickBooks, and I absolutely love being able to show people how to use QuickBooks. And I've got a couple of tips and tricks I want to share with you today about entering your sales in QuickBooks. And this gives people a lot of confusion a lot of times because they're just not quite sure how to enter their sales. You know, do they just enter deposits? Do they, enter invoices, sales receipts? How do they go about doing that? And so I'm going to show you today the process of choosing which form to use to get your sales in there, and then how to show that money in your bank account. Okay. Now, QuickBooks, you can see here we're at the home screen, and there are basically two forms that you're going to use for your sales. Okay, one is the sales receipt. Let me pull that up here. See, a sales receipt, it's a form that QuickBooks utilizes quite a bit in their software. Let me go back to the home screen. So we've got the sales receipt, and the other one is an invoice. Okay. Okay, an invoice. You see, in this form this template or this form looks very similar to the sales receipt. So how do you know which one that you're supposed to use? Let's go back over here to the sales receipt. The sales receipt, and it's very simple to differentiate. The sales receipt is used when you get paid immediately. So let's say that you own an auto repair shop, you've done some work for a customer, they come in to pay you. You're going to enter a sales receipt. Okay. Now, an invoice is when you do work for somebody or you ship a product to them, whatever the case may be, and they get to pay you later at some later date and time. Okay, so an invoice is when you get paid later, and a sales receipt is when you get paid immediately. Okay, simple enough. So let's walk through the process here of actually entering a sales receipt and an invoice so I can show you what happens to the flow of money in QuickBooks. So I'm going to pick a sample, let's say Renee Barley. Okay, as you can see, a little pop-up here has outstanding billable time and costs. We're going to get rid of that because we're not going to bill for that. We're going to pick an item. Let's say that we did some floor plans for Renee Barley, and we'll say one, and the cost was $1,235. Okay? And we hit save and close. Well, bam, she's paid. We printed that off, we gave it to her, and she's paid. So what happens to the money in QuickBooks? This is where it gets very confusing for a lot of people. Well, let me introduce you to an account that QuickBooks has. I'm going to pull up the chart of accounts over here. QuickBooks has an account called undeposited funds. You may have seen that on your chart of accounts in your QuickBooks file. Let me double click that and bring up the register, and you'll see that here is that $1,235 from Renee Barley. So why does it do that? Why does QuickBooks put it into undeposited funds? And it's really actually smart and simple at the same time. QuickBooks puts that money into undeposited funds because it assumes that you're going throughout your day in your business and you collect money from different customers. You got this $1,235, you got $1,375, you got some other money. And they're assuming that you're not going straight to the bank right when you get the money. They're assuming that, hey, you collect your money throughout the day, and then you're going to take it to the bank maybe at the end of the day or the next morning, the next day, once a week, whatever the case may be. So QuickBooks does not want you to automatically have that money go into your checking account because that may confuse you and make you think that you've actually got more money in your checking account than you actually do. So it's sort of a safety net, this account, undeposited funds. Okay, so how do we get it from undeposited funds to our bank account? Let's say we're going, we've collected our money for the day or for the week, and we're going to go to the bank. Well, what I always do is I go up to the banking drop-down menu and I go to make deposits. Okay? And you'll see here that the $1,235 shows up. So all I'm going to do is I'm going to check that off. I'm going to hit OK. it automatically populates this make deposit screen, and I'm going to hit save and close. So now what's happened is it's gone from undeposited funds. Okay, you'll see up here, there it is coming back out. And if I go to the chart of accounts and go to my checking account, let me scroll up here to the right date, you'll see there it is, $1,235. So what it did is it took it out of undeposited funds and put it into the bank account. Okay? So it's a two-step process. So now what we want to do is we want to create an invoice. I want to show you what happens when we create an invoice. Again, we've got our form template here. I'm going to pick somebody, let's say Mark Ballman, and we'll pick an item here, blueprints, and let's say that we got one, and this one is $24.69. Okay? So we've got our invoice out there. I'm going to print this thing off. I'm going to send it to Mark Ballman, and he's got 30 days to pay. Okay, so now we have out there what's called an accounts receivable, which is what somebody owes us. Somebody owes us money. So now let's say that all of a sudden, you know, on the 30th day, we get a check in the mail from Mark Ballman, and we need to know how to record that into QuickBooks. Okay, this is a couple steps here. First, what we want to do is we want to go to Customers and then Receive Payments, and alternatively, you can just click on this little icon here, Receive Payments. Okay, and we're going to go down to Mark Ballman, and there's his outstanding amount, $24.69, and the invoice that we created is down here. Okay, so $24.69, we're going to say he paid by check. It automatically applies it to that invoice, and bam, we've paid, or he's paid. Okay, it's a QuickBook marketing message. So now what happens to that money, it's sort of the same process as a sales receipt. Okay, it increases undeposited funds. You'll see it right here, because again, we got that check in the mail, and QuickBooks assumes we're not taking it directly to the bank. So we got it there. So now we've got to go again, we've got to go to make deposits. There it is there, we check it off, we hit OK, got it going to the checking account, and we hit save and close. So now it's out of undeposited funds, and you'll see it here in the checking account. Okay, so again, two ways to record sales: the sales receipt and the invoice. The sales receipt is when somebody pays you immediately. The invoice is when somebody pays you later. When you get that money and you record it in QuickBooks, it goes to the account undeposited funds, and then you have to make sure that you go to make a deposit in QuickBooks to take it out of undeposited funds and put it into your checking account. Well, I hope you enjoyed this little tip, these tricks on recording your sales in QuickBooks. If you haven't signed up yet for the full QuickBooks course, you want to make sure that you do get that training, because there's so many more tips and tricks that I show you in there, and show you how to use QuickBooks basically from A to Z, so that you can get your business up and running in QuickBooks, get that profitability up, and get your business running the way it should be. Thanks so much for listening.